Hey everyone, welcome back to Upside Down Data. Today I want to have a bit of a model talk, specifically talking about our risk indicator, the upside downside potential indicator, and how we might be able to integrate it with some other data that we have here on the channel. So if you're not familiar with the upside downside potential indicator, it is our risk indicator. It basically quantifies how much risk is in a given asset. So I'm going to use Bitcoin as the example for this video, but these concepts would apply to basically the UDPIs of other assets as well. So this is the price of Bitcoin across time, color-coded to the UDPI. You've probably seen this chart before. You know, red, higher values are high risk, lower values are low risk. You see it does a good job of quantifying Bitcoin risk over time, calling out the market cycle tops and also calling out the low risk zones throughout kind of the bear markets in Bitcoin's history. We can see this again if we just look at the raw output of the model across time. So that's what I'm showing you here. Again, yellow line is the Bitcoin price. And then the white line is the UDPI level across those times. Again, spiking up at these topping points in Bitcoin's history, bottoming out at these, bottoming out points, generally speaking. So that's the UDPI. We've seen this before. We talked about this extensively on this channel. So you've been following, you've seen this before. But I was curious, is there ways of integrating the data of the UDPI with some other models that we have here that would give us maybe a slightly different perspective than what the UDPI is giving on its own? So my thought was, could we integrate some data from the market direction classifier, the MDC, to kind of give an adjusted UDPI value based on what this model is saying? So if you're not familiar with the MDC, it's a trend model. It basically assesses the asset's price action and creates this critical level that it's watching, that if the asset can stay above it, that's bullish and can lead to these big parabolic moves. And if it's below it, that's bearish, can lead to these big, nasty downtrends. So the yellow line here is that critical level across time. So my idea is, could I come up with a way of slightly modifying the UDPI to take into account this this trend data to basically adjust the risk level based on the trend. The idea being that if you're in an uptrend, if you're in a bullish disposition on the MDC, you might want to treat that as a lower risk time, because again, if you're down in these zones and you're moving up, there's not really much reason to be concerned. Then you probably want to treat that as lower risk. Whereas if you've just come off at this point, you've just dipped down to the red, you might want to see that as being higher risk, because that might mean that you're going to go into this nasty downtrend. So again, these flips into bullishness should maybe be signs that you should treat that as a lower risk time than these flips down into bearishness. So that's the general idea I ran with. So what I'm going to show you next is a very rough way of trying to integrate these data. Some other ideas I'm going to play around with for maybe how to make this a little bit more sophisticated down the road. But for now, the approach I've taken is I've created this, what I'm calling for now, just an MDC adjusted UDPI. And basically what I've done is given the MDC the power to change the UDPI level by 1 point. And really the way that I've done that is just very simply, if the Bitcoin price is above the MDC critical value, then basically you're going to go ahead and shift risk down a point, because the idea again is that if you're going into one of these uptrends, you want to see that as being lower risk than going into one of these downtrends. So if the MDC is, or if the Bitcoin price is above the MDC critical level, so like at a point like this is just letting it shift the UDPI level down a point. And then if you flip bearish again, so if you go up and you flip, like up here, you flip below the MDC critical level, then that would actually then, shift the UDPI value back up. And so it's just a very simple if-then kind of treatment here. Again, not super sophisticated, just kind of a proof of concept is the way that I'm looking at this right now. And the results are kind of interesting, and they look a little bit different than the normal UDPI. Not extremely, but a bit different. It acts a little bit differently too. So let's walk through how it's different, and I'll show some side-by-side comparisons of just the UDPI on its own versus this adjusted version. I should also mention that the actual, so I've renormed basically the UDPI level to be between -5 and 5. Technically speaking, when you're letting the MDC shift it by a point, you can break the scale. You can go above 5, below -5. But I just basically renormalized this so that it's just easier to kind of compare the two against each other. So just a clarification there. So let's talk about some things that make this slightly different. And so one thing that I think we actually see it a bit better if we just look at this color-coded chart versus looking at the raw values that we're just looking at, is that one of the things that the MDC adjusted UDPI does is it tends to actually spike its highest level of risk slightly after these topping points in Bitcoin. And so the reason it does that, again, is that it's watching the MDC. And with the MDC, it's going to be watching it. It's going to be going up, up, up. And then the second it sees weakness, that's when the MDC is going to flip bearish. And so, like, for example, right here, that's the second it flip bearish, etc. And so, you might look at that and say, oh, wasn't that just lagging? Well, it's like, well, sure, but the MDC is always going to be slightly lagging, right? If we just look at it, it's going to wait until it sees that first moment of weakness to flash, bearish. And so from that perspective, we shouldn't be totally surprised. But what it does do is it basically will hold risk low until the MDC sees a reason to be concerned. Then it'll suddenly say, all right, this is now super high risk, get out. And it's just a different way of quantifying risk to some degree, because really it's just looking for a different signal to say that the asset is, going into a downtrend, for example. Then it'll flash that highest level of risk, which if anyone was looking at this in real time, with any asset they were still holding, that might just be that final trigger to kind of get out of there, that final kind of sell signal to kind of get out of the asset. And so we can look at these side by side to kind of look at them. And so as I mentioned, they're not super different from each other. You look at them and they're not extremely different. There is some minor kind of differences where there's a little bit more, differentiation at these bottoming points down here, for example, where, this point got a little bit lower in 2015 in this first bottom than it did back here, where it's really, kind of spiking down to -5 right at this one right here. Similar behavior in 2018. It's waiting to spike all the way down to that buy signal after we'd already flipped bullish on the MDC, so a little bit after this. And then also one of the ones that I think is more notable as well is that it spikes up to 2 at the second peak, back in November, whereas here there wasn't as much differentiation going on the normal UDPI. And again, also here getting up to 0 in this kind of fake out run back in March, whereas I didn't have it as much. And then as well here also, like we had this big capitulation going down into June, you'll notice that the initial risk level on the adjusted UDPI is actually a little bit higher than it was here, and then it waited to spike all the way down until we got a flip of the MDC to be bullish, and that's when it really triggered that, that buy signal, basically shooting it down a point because we just flashed, bullish on the MDC, shooting us all the way down, whereas here it went all the way down during the actual capitulation itself. So I think it's, and, we can also see this if we just look at, kind of the raw or the color-coded version. And so in some ways, I think it's a matter of judgment. I don't personally see one of these as necessarily being better than the other. I just think they're giving slightly different information. So if you're looking at the MDC adjusted UDPI, you're really looking at MDC that's trend adjusted. And so with that trend adjustment, you're kind of you're basically kind of accepting the fact that it's going to be waiting for more confirmation before flashing its highest level of risk. It'll get up to high level risks, but it's going to wait until it gets more confirmation of a breakdown before it really gives that big sell signal. It, kind of triggers the MDC adjusted UDPI to flip extremely high risk. Whereas with the normal UDPI, it's going to be, spiking up at the top point there overall. Now, one advantage that you might have with the MDC adjusted version versus this one, for example, though, is that you'll notice with the normal UDPI, it will be getting into the deep red a little bit earlier than the MDC adjusted UDPI, especially you can see it happening here, where here it's kind of, being a little more discerning and flashing red at more of those local tops, whereas here just kind of higher up in the red throughout this whole point. And so that's one thing that the MDC adjusted version will do, is it'll hold risk down a bit more until you get closer to the actual top, and then it'll spike up there. So I haven't done any backtesting yet to kind of test them against each other to see if one outperforms the other with different strategies. But I just thought it was interesting enough to share. And again, I think they're giving different information. So I'm not claiming that one is better than the other. I think it's just different information that it's providing, that it's just a trend weighted or a trend adjusted UDPI versus the raw UDPI in and of itself. So again, this is just a proof of concept, kind of a rough first pass, but I do think it's just an interesting thing that I'm going to continue exploring, this idea of taking the UDPI and then adjusting its output based on what some other data say. And so I want to play more with the MDC. I'm also curious to see what the TCI will do, because one of the things the TCI does is tends to be more of a front runner of these trend reversal points. That might kind of help shift that high spike back over towards the top a little bit more. Something that'll be interesting to see with that indicator. And I'll want to try it with some other models as well and see if, adding their data to the UDPI yields interesting results. But just wanted to share that. I think it's just an interesting idea, and this idea that we can take, multiple models, and instead of just having to visually, kind of on our own look across them to kind of get an idea, we might be able to just kind of more directly kind of integrate them together to give something like a trend-adjusted UDPI, which again will give you slightly different information than what the pure UDPI will give. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. But a lot of updates, better indicators, and more over there.